Well, good morning, Vero Beach. Welcome to the Financial Pulse Radio Show. I am your host, Danny Howes, CEO of East Coast Tax and Financial Planning, a local tax and financial planning firm located right here on Orchid Island off Azalea Lane here in Vero Beach. We are a full-service tax firm and financial advisory firm. We handle everything in the market, stocks, bonds, mutual funds. We have an insurance agency that handles things like long-term care insurance, life insurance, annuities, things that have to do with investments. And then we also have our beloved tax practice where we do tax preparation and accounting and bookkeeping for small to medium-sized businesses as well as individual investors and families. Well, welcome to the show. I'm sure everybody's just on the edge of their seat with the way that this market has just been roiling over the past 2 weeks. I've done a couple of video addresses addressing the situation last week. Last week, just in that week alone, we erased all of the gain for 2015 just in that short week. It all started when China basically had to halt trading because they were off by 7% just in one day last Monday. So they started halting trading. They're trying to figure out how to stop this free fall. They can't figure out how to get their economy back up and humming again. So, wow, what a lot of noise. We've seen the market swing triple-digit points, mostly down. In fact, yesterday the market was down. The Dow was down over 300 points. All the major indices were off 1 to 2%. Oil's down. It's just been a really rough ride since we started 2016. And folks, we talked about this towards the end of last year. Last couple of weeks of last year, we talked about, with all of the pressure that's facing this stock market. If you look back at the 2012, 2013, we got really drunk on returns. We made a lot of money. The broader markets did really well. You head into 2014, it wasn't the greatest year, but still did pretty well. But right at the end of the last quarter of the 2014, they stopped the billions and billions of dollars pumping into the market. They stopped that quantitative easing. Remember, let's paint the picture of what it was like, after 2008 and that crash. The government decided to be intrusive on our economy and our markets and decided to do some engineering. So they started with stimulus money. So we're going to go out, we're going to pump billions of dollars into the economy, we're going to buy stock in companies and insurance companies, and we're going to try to keep all these major institutions, the too big to fail institutions, afloat. And then that didn't work. So they decided, well, we're going to start quantitative easing, which basically means they're going to start buying bonds in the bond market to increase liquidity. And they're going to lower interest rates. So they started off with quantitative easing 1. And then once that ran out, they decided, okay, well, it's not working now, so we're going to do quantitative easing 2. And then, lo and behold, we had quantitative easing 3, which ended fourth quarter of 2014. Now look at what happened in 2015 after they stopped pumping all those billions of dollars into the market. It was tepid. It was basically flat, wasn't it? We didn't see hardly any growth. There was a little bit of growth, but not much at all as far as the broader markets are concerned. Then at the end of last year, for the first time in 6 years, they raised interest rates. And it was only a 0.25% interest rate increase. And don't get your hopes up. It's not like CDs and Treasury yields are going to go through the roof. It's not like you're going to be able to start making great interest on your savings accounts right now. In fact, those are the last things to move. Most of the banks are coming out and saying, well, we're going to rise interest rates and borrowing rates on mortgages and credit cards and that sort of thing. But don't expect to see increase in CD interest rates or money markets anytime soon. Really doesn't do much for us. Well, now that they've raised interest rates by 0.25%, and we have the ripple effect of China, and we have the fact that the market has been at an all-time high, which nobody feels warm and fuzzy about. Just about every investor that comes into my office, none of them feel warm and fuzzy and haven't felt warm and fuzzy as it relates to Main Street and what's going on for the small to medium-sized business owner. Sure, the banks and Wall Street and the traders are happy because all that liquidity made it easy to make money. But now look what's happening to the market. The Fed was really afraid to play chicken with rising interest rates. They were afraid to flip that switch because they didn't know what would happen. this is an experiment that has never taken place before. There's no economy out there that's ever actually been in this type of a situation. And so when we go from near zero interest rates to a whole whopping 0.25%, they didn't know what it was going to do to the markets, the economy, and investors. And Wall Street's reacting in a big way. I don't think it's only because China has gone the direction that they have gone. That's the only reason why the market's reacting. If you listen to my show or read my stuff at all, you probably know that I believe that this market has been built on a falsehood. And the government has tried to use financial engineering to try to artificially prop the economy up, prop Wall Street up, until the actual economy took off on its own. And some of the weak job numbers that came out, that even though they looked a little bit better, they still weren't great. And so they're hanging their hat on the fact that job numbers looked good during Christmas time when places like Macy's are going out and hiring temporary workers for the season. It's not working. Just look at yesterday's market. Again, another dramatic down market. Now, I know I've been hammering this. I've been talking about this for quite a bit, but this is important, folks. If you're listening to this show, you may have 1 foot in the door of retirement, 1 foot out of the door of retirement. You may have a 401k, you may have some IRAs, you may have 403bs or thrift savings accounts if you're a government employee, whatever the case may be. Those accounts have mutual funds in them. And most of those accounts, people aren't actively managing them themselves, meaning you're not going into your 401k and making all these changes all the time. And more than likely, you don't have an advisor that's doing anything like that. So you maybe have a set it and forget it type of target mutual fund, which means you set a date for retirement, and a mutual fund slowly but surely switches from equities to bonds and increases a more safer approach to the mixture of investments inside of those funds as you get closer to retirement. However, that doesn't mean you just need to ignore it. You're plowing thousands and thousands of dollars away a year into these accounts and hoping that that's going to be there when you retire. Well, if we look in the rearview mirror, just 7 short years ago, 2008, there were people doing that exact same thing. And what they didn't realize was there was going to be a 52% down over 24-month period decline surprise when they got to retirement. Lots of people worked 20, 30, 40 years to accumulate what they had, only to wake up one day and 30, 40, 50% of it was gone. Some people had to work longer. People had to go back to work if they were already retired. They had to go on a lifestyle diet because they just couldn't afford to maintain what they could anymore. We had people that were not even employed, that had to rely on their parents and had to rely on other people to help them out. There's still people underemployed as a result, or not even employed, stop looking for jobs as a result of that one downturn. It could be tremendously dramatic on your life. So what I'm encouraging everybody to do, get with your financial advisor, get with your 401k person at work, get with whoever's managing those funds, because if you haven't had a risk review and taken a look at this stuff, you have to as soon as possible, because this market's real and the danger is real. It could go either way. And I'm not saying this thing is going to completely crash and tank, but there's a lot of reasons why it could. And what would 30, 40% down mean to you? We've gotten really numb as investors because we've been making such good money over the last couple of years. But 2015 was a wake-up call. We didn't the broader markets did not make a lot of money. 2012, 2013, you could put a blindfold on and put a dartboard up, put stocks on it, and throw a dart, and you could probably make some money. But it's not like that right now. If you're retired and you haven't sat down with your financial advisor and done a risk review and taken a look at what you're invested in and at least get yourself familiarized to make sure you're not taking more risk than you thought you were, you need to do that too. That's the bell that I'm ringing going into the new year.